While headlines celebrate rising prices, vault inventories are hemorrhaging metal at rates not seen in decades. Industrial buyers are locking multi-year contracts. At premiums, the futures market refuses to acknowledge, and the gap between paper claims and physical availability has widened into something institutional risk models never anticipated. What happens when the world's most essential industrial metal becomes unavailable at any posted price? The answer is already unfolding. In places most investors aren't watching. And when this market reprices overnight, the business leaders positioned ahead of institutional recognition will understand exactly why timing mattered. Welcome to John Analyst, where we deliver strategic economic intelligence for serious decision makers. If you've built something, if you manage capital, if you understand that markets reveal truth slowly and then suddenly, then you're in the right place. I'd ask you to subscribe, not because I need the number, but because the analysis we deliver here does not show up in your newsfeed until it's already too late to act on it. This channel exists for the 1% who prefer preparation over reaction. Hit that subscribe button and do me one favor. Drop a comment telling me where you're watching from today. Are you in New York, London, Singapore, Dubai? I want to know where the strategic thinkers are positioned around the world. Now, let's get into why silver's current price structure is about to become unrecognizable. There exists a moment in every commodity cycle when price and reality separate, when the numbers on trading screens reflect yesterday's assumptions, while the physical world has already moved into a different configuration entirely. Silver has entered that moment. The metal trades today inside a framework most market participants still trust, a framework built on decades of adequate supply, liquid markets, and the assumption that posted prices represent actual availability. That framework is deteriorating, not through dramatic collapse, but through quiet erosion that only becomes visible when examined from multiple angles simultaneously. Consider the baseline economics first. For the past 3 consecutive years, global silver demand has exceeded newly mined supply by margins that would be considered crisis level in any other industrial commodity. Independent industry surveys document annual deficits ranging between 150 and 200 million ounces. Deficits filled temporarily through above-ground inventory drawdowns and recycling flows. But here's where the mathematics become uncomfortable. Above-ground inventories are not infinite, and recycling silver from industrial applications proves economically unviable at current price levels. The metal gets consumed in microscopic quantities across millions of devices, scattered into landfills, or locked permanently inside solar panels with 25-year operational lives. This creates a supply dynamic fundamentally different from reversible commodities like oil or wheat. When oil gets consumed, new drilling can replace it within months. When wheat gets eaten, next season's harvest replenishes supply. When silver gets embedded into a solar panel installed on a residential roof in Germany, the metal exits the available supply pool for a generation. The market has not yet priced this distinction. Now layer in the production structure itself. Approximately 72% of global silver supply emerges not from primary silver mines, but as a byproduct of copper, zinc, lead, and gold extraction. This means silver supply responds primarily to the economics of base metals, not to silver's own price signals. If copper demand softens due to slowing construction activity in major economies, copper mines reduce output, silver production falls accordingly, regardless of whether silver itself trades at $30 or $130 per ounce. This byproduct dependency creates supply rigidity that most financial analysts systematically underestimate. The mining industry cannot simply drill more silver in response to tightening markets, because the infrastructure doesn't exist. The investment timelines span 7 to 12 years, and most importantly, the silver isn't the reason those mines operate. So what happens when structural demand rises while structurally constrained supply cannot respond? The textbook answer suggests gradual price appreciation until demand destruction occurs or new supply emerges. But silver's industrial applications are not price sensitive in the way theory assumes. A solar panel manufacturer cannot reduce silver content below the minimum required for electrical conductivity without destroying product functionality. An electronics firm cannot substitute away from silver in critical switching applications without comprehensive re-engineering, new certifications, and reliability testing that spans years. Demand destruction in industrial silver doesn't happen smoothly. It happens through entire product lines becoming economically unviable, which typically occurs only after prices reach multiples of current levels. This sets up the dangerous market configuration now observable across physical silver channels. Exchange inventories have declined substantially over the past 18 months, even as prices have risen. Major vault networks report persistent outflows. Exchange-traded products, backed by physical silver, show redemption patterns inconsistent with typical investor behavior during bull markets. The metal is leaving visible storage, moving toward end users who require actual delivery. while paper markets continue operating as if supply remains abundant. And here lies the strategic blind spot. Most institutional capital allocates based on futures market liquidity, on the ability to enter and exit positions efficiently, on the assumption that quoted prices represent genuine two-way markets at scale. But commodity markets under physical stress don't maintain that liquidity when tested. They gap. The $200 to $300 price range being discussed in certain analytical circles is not speculative fantasy. It represents the mathematical outcome of a market discovering that available supply at current prices cannot satisfy committed demand. When that discovery occurs, it doesn't unfold through polite daily increments. It unfolds through overnight repricing that forces every participant, from industrial procurement officers to pension fund managers, to recalibrate their understanding of what silver costs in the real economy. The evidence suggests that recalibration may be closer than consensus opinion recognizes. And for business leaders allocating capital today, the relevant question is not whether silver reaches $200. The relevant question is whether their strategic positioning anticipates a market that stops trading and starts rationing. There's a category of materials in modern commerce that operates under different rules than typical commodities. Materials so embedded in critical infrastructure that their consumption becomes effectively mandatory regardless of price. Silver has quietly entered that category, and most strategic planners haven't noticed yet. The transition happened gradually over 2 decades, as silver evolved from a monetary metal and photography input into something far more consequential, the irreplaceable conductor inside the machinery of technological civilization. Walk through the architecture of this demand, and the $200 to $300 thesis stops sounding extreme. Start with photovoltaic solar cells. Each utility-scale solar installation requires between 10 and 20 grams of silver per panel. Applied as conductive paste that captures and transfers electrons with efficiency, no alternative material can match at comparable cost. Global solar capacity additions now exceed 400 gigawatts annually, translating to roughly 160 million ounces of silver consumed each year in this single application alone. But here's the structural lock-in that matters. Solar panels represent 25 to 30-year capital commitments. Once a government commits to renewable energy mandates, once utilities sign power purchase agreements, once installation begins, the silver demand becomes non-negotiable for decades. China alone is committed to 1,200 gigawatts of additional solar capacity by 2030. Europe's Green Deal mandates similar trajectories. The United States Inflation Reduction Act created subsidy structures designed to triple domestic solar manufacturing. These aren't market-driven decisions that reverse when silver prices rise. These are policy commitments with treaty obligations, climate targets, and political capital already spent. The silver consumption is already legislated, regardless of whether the metal trades at $32 or $232 per ounce. Now examine the electronics sector. Silver's electrical conductivity exceeds every other element. Its thermal properties allow heat dissipation in compact geometries, and its reliability across temperature extremes makes it irreplaceable in mission-critical switching applications. Data centers processing AI workloads, 5G network infrastructure, automotive computing systems managing electric vehicle powertrains, medical imaging equipment, aerospace guidance systems, industrial automation controllers. Every advanced electronic application trending toward higher density and greater reliability increases per unit silver content. And here's where substitution theory collapses. Engineers can theoretically replace silver with copper or graphene-based alternatives in some applications, but doing so requires complete product redesigns, new supply chain qualification, extensive reliability testing, regulatory recertification, and acceptance of performance degradation. For a smartphone manufacturer, that process spans 18 to 36 months. For aerospace or medical device applications, it can exceed 5 years, which means when silver prices begin rising rapidly, industrial demand doesn't respond by falling. It responds by accelerating as procurement teams rush to lock supply before prices move higher still. This creates the perverse dynamic observable in tight commodity markets. Rising prices initially increase consumption rather than reducing it, as fear of future unavailability overrides current cost considerations. The medical sector adds another layer of inelastic demand. Silver's antimicrobial properties make it essential in wound dressings, surgical instruments, catheter coatings, and water purification systems. Global healthcare infrastructure expansion, particularly in developing economies, drives steady consumption growth disconnected from price signals. Hospitals don't switch away from silver-infused medical devices because the metal becomes expensive. They switch when patient outcomes suffer, which means they don't switch. Then consider the defense and strategic applications rarely discussed in commodity analysis. Missile guidance systems, radar arrays, satellite communications, cryptographic hardware, all consume silver in configurations where performance cannot be compromised for cost savings. When defense budgets expand, as they have across NATO and Indo-Pacific allies, silver demand rises accordingly, and that demand operates completely outside normal price sensitivity. Add these sectors together, and a different picture emerges than the one reflected in futures market positioning. This is not discretionary industrial consumption that flexes with economic cycles. This is structural demand embedded in multi-decade infrastructure transitions, policy mandates with legal force, and technological applications where substitution requires years and performance sacrifices most industries won't accept. The market continues pricing silver as if demand remains elastic and responsive. But the consumption architecture now in place, the policy commitments already made, the technological dependencies already locked in, they've created something closer to a scheduled drawdown of available supply, proceeding at rates determined by solar installation timelines and semiconductor production schedules, not by price signals. And when markets discover that consumption has become mandatory while supply remains constrained, the repricing doesn't wait for analyst consensus, it simply happens. Markets lie, but inventories tell the truth. And right now, the physical silver inventories visible to institutional observers are communicating something the derivatives market refuses to acknowledge. They're vanishing, not through dramatic single-day events that trigger headlines, but through persistent, relentless, methodical withdrawals that have reduced available stockpiles to levels last seen when silver traded at multiples of current prices. The COMEX registered silver inventory, the metal actively available for delivery against futures contracts, has declined by approximately 78 million ounces since early 2024. That's not a statistical anomaly. That's nearly 3 months of global solar panel production disappearing from the exchange warehouse system. But here's what makes this movement structurally significant. Inventory drawdowns during rising price environments typically indicate one of two scenarios. Either speculators are taking physical delivery in anticipation of further gains, or industrial users are securing supply outside normal procurement channels because spot markets no longer offer reliable availability. The data suggests the latter. Major silver-backed exchange-traded products have experienced net outflows exceeding 110 million ounces over the past 18 months, even as silver prices climb from the low 20s into the low 30s. In normal market behavior, rising prices attract investment inflows, investors chase momentum, ETF holdings expand. The opposite is occurring, which means the metal isn't leaving because investors lost interest. It's leaving because someone needs actual physical delivery. And the easiest accessible pool of silver exists inside these investment vehicles through the redemption mechanism. Large institutional holders can redeem ETF shares for physical bars, withdraw that metal from custodial vaults, and redirect it toward industrial users willing to pay premiums above spot futures prices. Those premiums are widening. In Asian physical markets, buyers are reportedly paying $2 to $4.50 per ounce over London spot prices to secure immediate delivery of standard 1,000-ounce bars. In European markets, similar premiums have emerged for smaller retail formats. These spreads reveal stress. When physical buyers consistently pay above futures prices, it indicates the futures market is not providing adequate supply at posted prices, which means the price discovery mechanism itself has begun disconnecting from physical reality. Now examine the London bullion market vault data. Total silver holdings across London vaults have declined by over 280 million ounces since their 2021 peak. That's roughly 8,000 metric tons of metal, equivalent to nearly 30% of annual global mine production, simply removed from the wholesale market infrastructure. Where did it go? Some moved to Asia, some into private storage, some directly into industrial consumption. But the critical observation is this. The world's primary wholesale silver market is contracting its visible inventory during a period of rising industrial demand and constrained mine supply. That configuration has historically preceded disruptive repricing events in commodity markets. The paper-to-physical ratio presents another unsettling dimension. Open interest in COMEX silver futures represents claims on approximately 850 million ounces of silver. Registered inventory available for delivery currently sits near 220 million ounces. That's a ratio of roughly 3.9 paper claims for every physical ounce deliverable. In calm markets, this ratio doesn't matter because most contracts settle financially rather than through physical delivery. But markets don't stay calm when participants begin questioning whether delivery is genuinely available. And once that questioning begins, the scramble for physical settlement can overwhelm available supply within days, forcing cash settlements at prices that bear no relationship to yesterday's futures quotes. Industrial procurement officers are responding to these signals in ways that accelerate the tightness. Anecdotal reports from supply chain consultants indicate major electronics manufacturers and solar producers are moving away from just-in-time silver purchasing toward securing 6 to 12-month forward supply contracts. That behavior shift from spot buying to advanced contracting removes additional metal from the available pool, tightening the market further even if total consumption remains unchanged. The compounding effect becomes self-reinforcing. Tighter physical availability drives longer-term contracting, which removes more metal from spot markets, which creates greater tightness, which incentivizes even more forward buying. This is the inventory spiral that precedes discontinuous price events. Not because speculators create artificial scarcity, but because the physical architecture of the market can no longer absorb demand at prices, the derivatives complex continues quoting. When the break comes, it won't announce itself politely. It will simply gap overnight, leaving those who trusted paper liquidity staring at settlement prices they cannot access physically, and wondering why no one warned them that markets under stress don't trade, they ration. The question facing strategic capital allocators today is not whether silver reprices toward $200 to $300. The question is what triggers the recognition, and whether positioning occurs before or after institutional consensus shifts. History provides uncomfortable guidance on this timing. Commodity markets under physical stress do not transition smoothly from adequate supply to scarcity pricing. They remain superficially stable, absorbing incremental tightness through inventory drawdowns and extended delivery times, until a catalyst forces immediate recognition that the old price structure no longer reflects available supply. The catalyst typically arrives through one of three mechanisms. The first is delivery failure. When a major futures contract holder demands physical settlement and the exchange cannot source sufficient metal at posted prices, the market faces binary choices. Either allow prices to rise until supply emerges, or impose cash settlement at administratively determined prices that destroy confidence in the contract's integrity. Both outcomes trigger institutional repositioning away from paper exposure toward physical ownership, accelerating the very shortage that created the initial stress. The second catalyst is government intervention. When commodities become strategically critical, when national security implications emerge, when domestic industries face input cost crises, governments intervene through export restrictions, windfall taxation, or compulsory domestic sales requirements. Recent precedent exists across multiple commodity markets. Indonesia restricted nickel exports to protect domestic battery manufacturing. China imposed rare earth export quotas to maintain technological advantages. Russia leveraged energy supplies for geopolitical objectives. Silver's growing importance in renewable energy infrastructure and defense applications positions it squarely within this strategic framework. If major producing nations, particularly Mexico, Peru, or China, perceive silver as critical to industrial policy objectives, export limitations could remove millions of ounces from international markets overnight. The market would reprice before the policy details become public, not after. The third catalyst is simply time. Structural deficits compound. Each month of deficit consumption reduces available inventory. Eventually, the cushion separating current demand from available supply compresses to levels where normal market volatility can trigger supply disruptions. At that threshold, the market doesn't require a dramatic catalyst. It simply runs out of metal willing to be sold at yesterday's prices. So how should capital allocators position ahead of these scenarios? The framework requires understanding the distinct risk-return profiles of different silver exposure mechanisms. Physical ownership provides the most direct claim on metal, eliminating counterparty risk, but introduces storage costs, insurance requirements, and liquidity constraints during rapid price movements. For institutional allocators, physical silver offers definitive protection against delivery failures and cash settlement scenarios, but requires accepting that exit liquidity may deteriorate precisely when repricing occurs. Mining equity exposure offers operational leverage to rising silver prices as revenue increases while costs remain relatively fixed, potentially generating multiples of the metal's price appreciation. However, mining equities carry execution risk, jurisdictional instability, management competence variables, and correlation to broader equity market sentiment that can override silver-specific fundamentals during risk-off periods. The sophisticated approach combines both exposures. Physical holdings provide portfolio insurance against discontinuous repricing and delivery stress scenarios. Select mining equity positions, particularly in primary silver producers with low-cost operations and jurisdictional stability, capture the operational leverage if repricing unfolds gradually enough for equity markets to recognize expanding margins. But allocation must account for the liquidity illusion. Paper silver markets currently offer substantial depth. Exchanges facilitate large transactions with minimal price impact. Derivatives allow flexible position sizing. That liquidity exists because most participants assume they can exit when desired. When physical tightness forces recognition that paper claims exceed deliverable metal, that assumed liquidity evaporates. The exit door narrows precisely when the crowd reaches it simultaneously. This is why positioning must occur before consensus recognition. By the time institutional research departments publish reports confirming supply deficits, by the time financial media highlights inventory declines, by the time conference presentations discuss repricing scenarios, the asymmetric entry opportunity has already closed. The $200 to $300 range represents not speculative excess, but mathematical adjustment to a market transitioning from adequate supply assumptions to constrained availability reality. For business leaders managing strategic capital, the relevant decision framework is straightforward. Either the structural deficit thesis is incorrect, in which case modest silver exposure costs little, or the thesis is correct, in which case positioning ahead of institutional recognition generates asymmetric returns that compensate for years of portfolio underperformance elsewhere. The evidence, from inventory data to industrial demand trajectories to policy developments, continues accumulating on one side of that equation, and markets that reprice overnight don't send invitations. They simply open differently one morning, and by then, strategic positioning has already determined who benefits and who explains.